So friends, here in this video in the class number 81, I will give you a comprehensive comparison table or comparison chart of cash credit overdraft and drop line overdraft facility so that you can clearly understand the differences between them and the similarities between them. So credit overdraft and drop line overdraft. So the purpose, so first point is the purpose. Cash credit limit is given for your working capital purpose only. Overdraft limit is also given for working capital purpose only, and drop line overdraft is also given for working capital purpose. It can be, some banks are allowing the drop line overdraft for capex purpose also, but it is practically not correct way to go. So the core theme of drop line overdraft is working capital only. Rate of interest. The cash credit enjoys the lowest rate of interest as compared to both of these facilities, right? So the interest rate is lower in cash credit as compared to overdraft and drop line overdraft. While in overdraft, you will have to pay the higher rate of interest due to lower monitoring levels. In drop line overdraft, you are giving higher tenure as well, right? Property coverage. In the cash credit limit, you will enjoy lower property requirement because you have charge over the current assets as well. Your facility has multiple levels of monitoring involved, so the collateral requirements will be lower. But in the overdraft facility, the collateral requirements will be higher, but the collateral requirement will be highest in drop line overdraft facility because of higher tenure offered in drop line overdrafts. Stock statements are required in cash credit, but they are not applicable in overdraft and both drop line overdraft facility. Drawing power calculation is applicable on cash credit facility. Drawing power calculation is not applicable on overdraft and drop line overdraft. But like I have explained in my previous video, if you have taken cash credit facility and you have taken overdraft facility also, then indirectly the overdraft facility will impact your drawing power calculation. Similarly, some banks take indirect impact of overdraft, drop line overdraft facility also in drawing power calculations, just like overdraft facility. But some banks are not considering as single rupee impact of drop line overdraft facility in drawing power. So this is practically bank's own call only. Stock audit is mandatorily required in cash credit, but it is not applicable in overdraft and drop line overdraft. Credit comfort is highest in cash credit due to end use monitoring involved here. It is lower in overdraft facility due to lower monitoring involved, and it is lowest in drop line overdraft because of higher tenure offered in this facility also. Tenure. The overdraft facility and the CC facility is repayable on demand, and it is given, they both are given for 12 months period. But the drop line overdraft facility is a long-term loan facility and it is given up to 15 years tenure to you, right? Now comes repayments. In cash credit facility, the repayment, basically it is repayable on demand. Bank can send you a letter and ask you to pay off your cash credit and overdraft facility in full. But it doesn't usually happens. It happens only in the case of probable NPS cases. But till that thing happens, you only pay monthly interest in your account. Similarly, in drop line overdraft, you pay only monthly interest in the account. But in drop line overdraft facility, you pay both principal and interest as well. So both payments are involved in drop line overdraft facility. Now comes the assessment. Cash credit is based on MPBF method. You can use turnover method, you can use working capital gap method, you can use the NWC method, whatever method which is followed by the banks as per their internal norms or as per the turnover norms, right? So similar to cash credit, overdraft facility also is assessed on the MPBF method, turnover, working capital gap, or your NWC method. But in drop line overdraft, your primarily assessment is based on DSCR and FOIR. If the DLOD is given by the lab department, then assessment is done basis FOIR, and if it is given by the working capital department, then assessment is based on the DSCR. But since the drop line overdraft is given for the working capital purpose, some banks are making internal policy to assess the drop line overdraft on dual basis. They assess it on DSCR also, and they assess it basis MPBF also, right? Nature. The cash credit facility is revolving in nature. You can deposit the amount, then you can again reuse the amount. It is not, the limit doesn't crystallize when you use the limit in full. If your limit is 1 crore rupees, and you have used the limit in full at 1 crore rupees and you get the payment of 15 lakh, your limit utilization reduces to 85 lakh, then you have eligibility to use the 15 lakhs back again. This is the concept of revolving. So all these three facilities, cash credit, drop line overdraft and overdraft facilities, enjoy the feature of being revolving facilities. Now comes the main limit and sublimit structure. The CC can be given as main limit and can be given as sublimit also. Similarly, overdraft limit can be given as main limit and can be given as sublimit also. But the drop line overdraft facility cannot be given as sublimit facility because of its monthly repayment structure. Charge over current assets. When you give the cash credit facility, the charge over the current asset is mandatorily taken. In overdraft facility, the charge over current assets may or may not be taken. Some banks are taking it, some banks are leaving it. So it is purely based on the bank's internal guidelines and internal policies. There is no fixed standard for this. For drop line overdraft facility, in 99% of the case, the charge over the current assets is not taken. But some bank may choose to take it if they wish to, but in most of the cases, it is not done. Now, exposure restriction. There is no restriction of exposure in cash credit facility. What do I mean by that? If you want a 50 crore, 100 crore, 200 crore limit of cash credit limit, the banks will give you the 150 crores and 200 crores limit as per your eligibility. There is no maximum capping up to but by which amount the cash credit facility can be given. But the restrictions are applicable in both drop line overdraft and overdraft facility. Usually some banks with the higher risk appetite have the policy to give maximum overdraft of up to 10 crore rupees. Some banks with lower risk appetite has the approval to give overdraft up to 5 crore rupees or 2 crore rupees or 1 crore rupees, or some bank may even have no risk appetite to give overdraft facility also. They may only go with the cash credit facility, right? Similarly, the drop line overdraft facility, you cannot give unlimited amount of drop line overdraft. There is a particular amount that is restricted, so which depends upon the risk appetite and the different policies of the bank, just like overdraft facility. Now, annual renewal. Cash credit limit is given for 12 months and it is repayable on demand, and after the end of the 12 months you have to renew the limit for next 12 months period also. Similarly, you have to do it for overdraft facility also. But in drop line overdraft facility, if it is given by the LAP department, then there is no concept of renewal. But if it is given by the working capital department, then they do annual renewal of DLOD facilities as well. So this was the comprehensive comparative chart highlighting all the similarities and all the differences between all these three facilities. I hope you have liked the video. We will meet in the next video covering machinery term loans. Stay tuned with this channel. Thank you very much.